Sustainability Leaders strategy performed well on both an absolute and a relative basis during the second quarter. This is a relatively concentrated portfolio, so stock selection is what typically would drive performance in any given period. We tend to focus on companies that have strong, high-quality financial characteristics, as well as very good sustainability profiles. From a financial perspective, we're looking for companies that have strong balance sheets, good free cash flow generation, high returns on capital, and management teams that allocate that capital effectively for shareholders. And then from a sustainability perspective, we're looking for companies that have very robust environmental, social, and governance practices embedded into the business operations. Specifically in the second quarter, we had good performance across the portfolio. 10 out of 11 sectors outperformed their benchmark. The most notable outperforming sector was technology, which returned about twice that of the benchmark. Solaredge is a technology company that we've owned for a number of years that is not a household name. It's less than $3 billion in market cap. However, this is a very innovative company that has developed a technology that helps solar installations run more effectively. And we think that this is a company that's going to continue to gain market share in a market that's growing rather rapidly. Also in the industrial sector, we focus on a few companies that are focused on the issue of water scarcity. So we own Xylem and Evoqua Water Technologies, and these are companies that help conserve water for customers and make it more affordable, clean, and accessible. And these services tend to be in very high demand by both municipal and commercial customers. So financials was the one sector where we underperformed our benchmark, the Russell 3000, during the quarter. However, the underperformance was relatively modest. We had two stocks that were down low to mid-single digits during the quarter, First Republic Bancorp and Charles Schwab. However, that underperformance was counterbalanced by strong performance in some of our other holdings in the insurance and asset management industries. One of the hallmarks of this portfolio and a differentiating factor is that we don't invest in companies involved in fossil fuel extraction or mining. We believe that these companies are going to be increasingly obsolete as the economy transitions to cleaner forms of technology. So rather, we focus on investing in companies that develop cleaner forms of energy, like solar, wind, geothermal, and hydro. In fact, we have investments across all of those categories. So the first half of 2019 was obviously very good for equity holders. We saw strong double-digit returns. Of course, this followed a pretty poor fourth quarter, where we saw a pretty severe drawdown in the equity markets. So we've largely just filled that gap. That being said, we try not to make short-term market predictions. However, we feel very good about our holdings and their positioning, and we think that high-quality companies with strong sustainability profiles should continue to perform well through full market cycles.